Hello, good morning, ladies and gentlemen. We start this week's review by looking at the yield of the 5-year notes. It actually ended the week at the lowest levels of the week. As you can see, 1, 2, 3, 4, 5. It actually has filled the gap that it produced at the start of the week. So the yields are actually telling us that we have a bit of an exhaustion in this pattern, more likely to come back down towards 275 and retest these gaps down to 273 in the 5-year note. So we have a bit of a lull in the tightening cycle, and that can also be seen in the futures on this side. We are more likely to come back up and test these levels around 113, 24, 26, 27 rather than make any new impulsive moves higher. But when we look at the 10-year and the 30-year, we'll see that the yield curve keeps on flattening, and that is not a long-term good sign for the economy and or the stock market as a whole. And here we have the 10-year note. As you can see, that also finished at the lows of the week, and it's a much more pronounced weakness than it is in the fives. The yields in the tens could easily come back down towards 280, 290 in the couple of days ahead, and wait for these moving averages to catch up, which would further flatten the yield curve. A flattening of the yield curve shows very much indecision in the way the rates, especially long-term rates, are going to go. It is very much an indication that the economy is flattening out and that the market is digesting some further impulses which will come later on. In the 10-year note, it would not be surprising to see 120 again. 120 would be a very comfortable level, trading again between 120 and 120.16, something like that, is not to definitely a very strong possibility and something which can't be discounted. When we look at the 30-year note, this is TLT on a weekly basis. It has actually given us a bit of a buy signal, indicating that we should definitely go back towards 120.65. It is in a precarious position longer term if you look at the longer term chart, but it's not showing any momentum on the downside at the moment. It's finished at the high tick of the week. It could easily go to 120.65, as we said. This is a very, very indeterminate picture that we are seeing, and if we look at the yields of the 30-year note, as we're doing now, we can see that there is zero impulsion. We tried very hard to break the top that we have around 320, and 322 is the level that Gundlach keeps on talking about. We tried, we failed, we're back down. These moving averages are not very encouraging. We could easily go back towards 305 in the days ahead. It is utter indecision. The short end of the curve is actually being held by the long end. The long end is just not allowing the yields to go much higher, and therefore any movement in the 2s and 5s is going to be minimal compared to the movements in the 30s from now on. Very much an indecisive picture. A picture which says best be square at these levels and then only wait for a break and close above 322. As Gundlach suggests, 322 is now so important that if we break it higher, we are going to have a deflation of the stock market like we haven't seen for a long time. As far as stocks are concerned, don't really know what more to say. The market is basically trading still in a range, and it is supported by the 200-day moving average. A market which has now had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 basically touches of the 200-day moving average, and cannot break it. It just isn't, there isn't enough impulsion. It is more likely to trade above 271 than not at the moment. Basically get all the shorts out the way, and then we can see. Uh, all I can say is that a market which has that many touches of the 200-day moving average eventually tends to break it and have a complete nightmare. Uh, this is really visible in the individual stocks. Something like Apple, which has broken the 200-day moving average, but it basically, the market is being held up by individual names like Amazon, and it's just a market which is churning because there is no leadership. If the leadership happens to the downside, we will see a very, very swift move into the 2450s. That is what is likely to happen. But for the meantime, all we can say is anywhere around above 270, the market is likely to stall and retest the downside. But until we see a weekly close well above the 2017s, or a break of the 200-day moving average, we are basically trading the range. If we were to zoom out and have a look at the weeklies, well, very much the same picture emerges. We have a market which is trying, but keeps on stalling and basically closing just around the 5 EMA and this level, which is completely flat. And this basically is telling us that the market is correcting some very, very long-term imbalances, and that both bonds and equities are deflating. Neither of them is in trend. Both of them are now just going sideways. It is neither risk on nor risk off. It's more of a deflation of a trade which has been put on for many a year, which is long bonds, short volatility, long of equities, and that is just being deflated week after week after week. Long term, that could be very bullish, very long term, if you look at, a 2-3 year horizon. But short term, it is more likely to lead to downside shocks than it is to upside shocks. Why is what is happening? Well, the dollar is taking the strain. If you remember, our thesis was that the dollar would weaken, which it started doing very nicely. This is a chart of the Euro USD daily. It went up basically from below 110 all the way up to 125. We thought 126, 126.50 was going to be very, very difficult to break, and so it has proved. The dollar has now strengthened a tiny little bit. It's still well above the 200-day. It's not even tested the 200-day, which is quite close. And now we're going to have some sideways action between the 200-day and this middle Bollinger Band. And so 122.50, 120 should be the range for the next several days before the market decides what to do. It is not in a position to break the 200-day moving average on the first touch. It is going to take several attempts to do so. When it does, then if it does and breaks down, then we will probably come back all the way down to 115, which was such an important level. And that is probably why European equities at the moment are looking so much better than US equities. This is a chart of the DAX, and you can see it is now back up to the 200-day moving average, which it failed to touch when the market in the States was trading at 2800. So you can see how much better the DAX is performing in the last few weeks, and that is a direct result of the weakening of the Euro USD, i.e. of the euro. So the euro has allowed the DAX to go and touch the 200-day moving average. It is unlikely to break it by very much. We have a lot of resistance around the 12,780 level. It is unlikely to do very much, and that this is very completely supporting our thesis that the dollar is not going to go ramping higher. So anywhere around 93 to 93 and a bit in DX is going to be a great level to buy some puts on the dollar. Well, we're all asking ourselves what on earth is going on in European yields, and you can see that the answer, this being the bobble, the 5-year, is not much. What we do know is that at some stage Draghi will give the green light for yields in Europe to move higher. At the moment, that is not the case. The more the dollar actually takes the strain and the euro comes off, the more likely Draghi is to bring that timing forward. So a stronger dollar is actually long-term bearish for yields in Europe. This chart is very clear. Should the bobble close below -8 basis points, then it probably will go to -20 basis points. If it holds next week around -8, it has a chance to resume its move back up towards 10 basis points or so. So we will concentrate on that and very much take our guide from what the market tells us next week. That the bobble is unlikely to go down in yield and more likely to go up in yield is actually very much supported by Italian 10-year yields. They are now at the bottom of the Bollinger Bands in the weeklies, and they're more likely to move to 190 from 170 than anything else. So if Italian and German yields move higher, and if US yields move slightly lower, or basically the yield curve just flattens, we are likely to have an environment where European stocks are actually will weaken again against US stocks, and US stocks will be well bid. So this is something that we will be very much looking to comment on as next week trades, and we will be putting some probably some short DAX trades, long ES trades in the next few days. With all that said, what are the biases for next week? Well, 5s and 10s looking for a range trade, but we will definitely follow the break. If we are wrong and the yields start breaking higher, and now we have some very definitive levels in 5s, 10s, and especially 30s, we will definitely know what to do. A break of 322 in the 30s is going to be extremely deflationary for the stock market. It's going to be a bit of a shock. So that is what we are looking for, and that is what we will follow. We prefer to be short of bunds and bobbles, especially bobbles, because bobble, we know if there's very little that is certain in this world, but we know that they will trade around 2% at some stage. It's just a question of the timing. Therefore, we are prepared to suffer your amount of false starts before we make the big bucks. Commodities are definitely outperforming at the moment. They are outperforming the stock market, but we are looking for SPX now to slowly start outperforming the European equities. The Europeans have already moved to the 12,650 level we looked at. We are squaring up our position in Europe and looking to transfer the longs into the US, where we think at some stage the dollar stops and therefore equities in the US catch a bid. We still see absolutely no problem with our butterfly. It is a winning long-term trade. It is very much something which you need to think about putting on at some stage. XLK long, short SPY, long EM. It is again you have to suffer some pain to catch the big trends, and this is definitely one of them. Thank you very much indeed, and tweet to you on Monday.